Something doesn't feel right. You make more money than you did 5 years ago, you work harder, you save more carefully. And yet, everything feels heavier. Your grocery bill looks wrong, your rent doesn't make sense, your insurance went up for no clear reason, your future feels smaller. You're told inflation is cooling, you're told the economy is resilient, you're told you're doing fine, but your bank account tells a different story, and here's what nobody will say out loud. This isn't a glitch, this is architecture, and until you see how it's built, you'll keep feeling like you're drowning without knowing why. The surface question is simple: why did prices go up? But that's the wrong question. Prices always go up, that's normal, that's expected. The real question is deeper. And it's the one that keeps you up at night. Why does it feel like you're running faster just to stay in place? Why does math never work anymore? Why can't you afford the life your parents built on salaries lower than yours? This isn't about inflation, not really. This is about something fracturing beneath the surface. Something structural, something that affects every decision you make. Every dollar you spend, every future you're trying to build. And almost nobody is talking about it with any clarity. Until now. Here's how the story is supposed to work. The economy grows, productivity rises. Workers get paid more, things cost more, but purchasing power stays balanced. That's the social contract, that's the promise, that's what you were taught to believe. And on the surface, the data looks fine. Unemployment is historically low, GDP remains positive, stock markets keep setting records, headlines celebrate resilience and recovery. If you only looked at dashboards and press releases, you'd think everything was working perfectly. But here's the fracture no one explains properly. The numbers are accurate, they're just not real. Average wages have gone up, but average doesn't mean you. It means a small number of massive increases pulling the curve upward while most people flatline. Housing has appreciated dramatically, but only for people who already own it. For everyone else, it's a wall getting taller every year. Stock markets have surged beyond expectations. But 60% of Americans own almost nothing in equities. The party is real, you're just not invited. You're looking at a scoreboard that measures a game you're not even playing. Do you see the pattern forming? Now let's talk about why this keeps happening. Forget ideology for a moment, follow the incentives. That's where truth lives. When prices rise faster than wages, who actually benefits? Corporations with pricing power benefit first. They pass increased costs directly to consumers while protecting their margins. Profit remains steady, your budget doesn't. Asset holders benefit second. Their real estate appreciates in value. Their stock portfolios swell. Meanwhile, your cash savings quietly depreciate. Governments benefit third because inflation erodes the real value of debt, and the United States government is carrying over $34 trillion of it. Inflation isn't a crisis for them, it's a slow-motion bailout. Now ask the uncomfortable question. Who carries the risk? You do. You carry it in every paycheck that purchases less than it did last year. You carry it in every rent increase you have zero power to negotiate. You carry it in every future expense that's outpacing your ability to prepare. You carry it in the growing distance between where you are and where you thought you'd be. This isn't conspiracy thinking. This is incentive alignment. This is game theory at a civilizational scale. The system isn't failing. It's working exactly as it was designed, just not for people like you. Here's where it gets uncomfortable. This isn't the first time this exact feeling gripped a generation. In the 1970s, the United States experienced something called stagflation. High inflation, stagnant wages, slow economic growth. People worked harder and fell behind. They did everything right and couldn't get ahead. Sound familiar? The official response was aggressive interest rate hikes. Paul Volcker pushed rates to nearly 20%. The idea was simple: pain now for stability later, and technically it worked. Inflation was crushed, but here's what happened underneath the headlines. Wealth consolidated dramatically. Small businesses collapsed under the weight of borrowing costs. A generation of middle-class ambition was quietly crushed. The people who owned assets before the crisis emerged owning significantly more after. And here's the part they don't emphasize in economics textbooks. The crisis wasn't actually solved. It was transferred, debt expansion became the answer. Credit became the replacement for income growth that never came. The American dream didn't die. It got refinanced. For decades, cheap debt masked the erosion of real purchasing power. People couldn't afford things with income alone, but they could afford the monthly payments. And that worked until it didn't. 2008 was the first crack, 2020 was the second. And now, interest rates are elevated, debt is more expensive than it's been in decades, credit cards are maxed, savings are depleted, the mask is slipping. Would you have seen this pattern 10 years ago? Would you have prepared? Or would you have trusted the headlines like everyone else? Think about your own financial decisions over the past 5 years. Did you feel the shift before it arrived, or did you assume someone would fix it? Did you adjust your strategy, or did you believe the default path would hold? There's no judgment in these questions. Almost nobody saw it clearly, because the system is engineered to keep you focused on survival. On the next bill, on the next paycheck, on the next crisis that demands immediate attention, not on the deeper structure shifting beneath everything, but you're paying attention now. And that changes the equation entirely. Let's stop talking in abstractions. Let's make this tangible: your salary. Even if you received a raise last year, unless it exceeded real inflation, you actually took a pay cut, not on paper, in practice. In what your money can actually buy. Your savings. If your money sits in a standard bank account earning 2% while real inflation runs higher, you're not saving. You're watching your purchasing power slowly evaporate. That emergency fund you built, it's shrinking in real terms every single month. Your housing situation. Whether you rent or own, the mathematics have shifted against anyone trying to enter the market for the first time. In many major cities, home prices have outpaced wage growth by a factor of 3 or more. Your parents' generation wasn't smarter. They were earlier. You're not imagining the pressure. You're accurately measuring it, and here's the deeper threat nobody discusses openly. This pressure compounds. Every year the gap isn't closed, it widens. Every year you can't buy assets, you fall further behind those who already own them. The people who bought before the shift, they ride the wave upward effortlessly. The people still trying to board, they face a steeper climb with worse tools every single year. This isn't about working harder. Plenty of people work incredibly hard and get nowhere. This is about understanding the terrain before you exhaust yourself moving in the wrong direction. Does this feel familiar yet? So what actually explains why everything feels so expensive? 3 forces converging at the same moment. First, decades of monetary expansion are finally expressing themselves in real prices. The money supply expanded dramatically. Eventually, that appears in what things cost. Second, structural inequality is baked into the architecture of asset ownership. Gains don't distribute evenly. They concentrate among those who already hold assets. This isn't new, but it's accelerating. Third, the erosion of purchasing power was masked for decades by credit and cheap debt. Borrowing replaced earning. That runway is now shrinking as interest rates rise and lenders tighten standards. Put these 3 forces together and you don't get a dramatic collapse. You get a slow squeeze, a quiet pressure that builds year after year without any single event to blame. No single headline will explain it. No single policy will fix it, and that's precisely why it feels so disorienting. You're not crazy, you're not bad with money, you're not failing because of personal weakness, you're living inside a system that was designed long before you were born. And it's shifting beneath your feet in real time. Understanding this won't make groceries cheaper tomorrow. Understanding this won't lower your rent next month, but it will fundamentally change how you navigate. What you prioritize, what you protect, what strategies you pursue going forward. And that clarity, that's worth more than any single tactic. Most people will watch prices rise and blame themselves. They'll assume they're not earning enough, not saving enough, not disciplined enough, not trying hard enough. They'll internalize a structural problem as a personal failure, and they'll never once examine the architecture creating the pressure. But you did. You followed the incentives to their source, you traced the historical patterns. You ask the question most people are too distracted to consider. That puts you ahead of the vast majority. Not because you have more money, not because you have special access. Because you have clarity. And in a system specifically designed to keep you reactive and distracted, clarity is the asset that compounds. The patterns aren't slowing down, the pressure isn't disappearing. The shifts aren't revering themselves, but the few people who understand how the architecture actually works. They adapt before the rules change again, they position before the crowd notices. They move differently because they see differently. This channel exists for that exact reason. Not to explain finance like a textbook, to expose the patterns beneath the surface. If that's what you're looking for, you're exactly where you need to be. There's more to uncover, and the patterns are only getting clearer.